Hi there, and welcome to this online lecture where we're going to be looking at one of the topics covered in level 2 of the AAT. This is very relevant to the new qualification paper, Control Accounts, Journals and the Banking System. Well, it's also relevant to the old qualification, Basic Accounting 2 paper. Well, my name is Gareth. You've got my email address there, garethjohn@fi.co.uk. I'm a managing director with First Intuition, one of the UK's leading accountancy colleges. In the last few years, we've won UK Accountancy College of the Year in both 2010 and 2012. I was very, very pleased to be awarded the UK Accountancy Lecturer of the Year in 2011. And more recently, we were nominated for Study Resource of the Year in 2013. Well, in this online lecture, we're going to be looking at how to deal with certain control accounts. Now, the task that we're going to be examining is dealing with the sales ledger control account, which is a record of our total trade receivables balance. So trade receivables is the sales ledger control account. Obviously the sales ledger is dealing with the amounts owed to us by our credit customers, and that is our trade receivables balance. But in fact, before we start examining this particular task, I just want to go back and do a little bit of background to our control accounts that you need to be aware of for this syllabus. And in fact, before we even worry about the control accounts, let's actually have a quick reminder of the basics of double entry, because control accounts are ledger accounts or T accounts, and so we need to understand when we're going to be posting debits or credits to any given T account. Well, when I'm remembering my basic double entry principles, I always use the dead click mnemonic. So dead click reminds me that, well, on the dead side, debits, well, what can they represent? Well, a debit can be an expense. So for instance, if I pay a telephone bill, I will be debiting the telephone expense ledger account. Debits can also be assets. So if I bought a machine, for instance, for my factory, that's an asset of the business. So I debit the machine ledger account. And debits can also be used to show drawings. So if the sole trader who owns the business takes some money out, if they take some drawings, I would debit the drawings ledger account. So debits can represent expenses, assets, or drawings. Well, but on the click side, well, this helps me remember what credits can represent. So credit can be a liability. So if I was to borrow some money from the bank, and I therefore have a liability of that loan that I owe to the bank, I would credit the loan ledger account. Credits can also represent income. So if I make sales to customers, I will credit the sales T account. And credits can also be capital. So if the sole trader, if the owner of the business pays money into the business, what we refer to as a capital injection, I would credit the capital account. Now, the thing to bear in mind about this dead click mnemonic is this is all about how we increase any given item in our accounts. So to increase an asset, we debit it. So when I buy a machine, I debit the machine ledger account. If we want to reduce an item in our accounts, we're going to have to do the opposite. So debits increase assets. So if I want to reduce an asset, I would have to credit it. So if I sold a machine, therefore reduce the number of assets owned, I would be crediting the asset ledger account. So we've got our dead click mnemonic. Now, for the purposes of control accounts, it's most relevant to be thinking about the assets and liabilities. Because, for instance, the sales ledger control account is an asset that is showing what we're owed by our credit customers. We therefore debit the sales ledger control account if we want to increase it. Whereas the purchase ledger control account, for instance, which is showing what we owe to our suppliers, that's a liability. So in fact, to increase the purchase ledger control account, we're going to need to credit it. So you've got to be very careful about which control accounts show assets and which control accounts show liabilities. For instance, and if we just start reminding ourselves of the real basics of control accounts, if we were looking at the sales ledger control account, now the sales ledger control account is the total amount owed by our credit customers. That's the total trade receivables balance. This is therefore an asset ledger account. Now, assets feature on the dead, don't they? So we debit the sales ledger account if we're going to increase it. So for instance, if we make some credit sales, if we issue some sales invoices, we would debit the sales ledger control account to increase the outstanding balance. And if we want to decrease it, we're therefore going to do a credit. So if those credit customers were to pay me some money, if they make a payment, that reduces what they owe me, so we'll have a credit balance for that payment. So on the sales ledger control account, we debit to increase and credit to decrease. The purchase ledger control account is actually exactly the opposite way around, because the purchase ledger control account is showing the total of what I owe to my suppliers. This is therefore a liability. Now, liabilities are on the click side of my dead click mnemonic. So if I'm increasing the purchase ledger control account, I actually want to post a credit entry. So if I receive some purchase invoices from suppliers I've bought from on credit, well, those purchase invoices would need to be a credit entry on the purchase ledger control account. To decrease the amount we owe to our suppliers, we would post a debit. So if I make a payment to those credit suppliers, we would debit the purchase ledger control account to reduce the outstanding liability. You might also come across the VAT control account, which is recording our position with Her Majesty's Revenue and Customs. And it kind of depends on the situation. A lot of businesses will owe money to the VAT man. Now, if you owe money to the VAT man, that would therefore be a liability. Now, liabilities are on the click side, as we just saw with the purchase ledger control account. So we would have postings on the credit. Now, why would we owe money to the VAT man? Well, if we've added VAT to our sales, as we're required to, if we've added VAT to our sales, we don't get to keep the VAT. We would owe that to the taxman. So basically, if we have charged output VAT on our sales, that would generally be posted as a credit entry to the VAT control account. On the debit side, remember debits, well, that's the dead, so this would be an asset. So this is if I'm owed money by the VAT man. And occasionally businesses might be in a position where they can reclaim money, particularly if they've suffered large amounts of input VAT. If we've suffered input VAT, we would be looking to reclaim it from HMRC. So input VAT on our purchases would be shown on the debit side of the VAT control account. Well, that's just a little reminder of the basics of the typical control accounts you might see in this unit. But let's go back to our task that we're going to examine now. The task we're looking at is looking at the trade receivables balance. The sales ledger control account. This is the amount we're owed by our customers. This is therefore an asset, isn't it? This is an asset of the business. If it was the trade payables, which is the purchase ledger control account, then we'd be dealing with a liability. Now, we're given a balance at the 1st of January of £15,430. So at the beginning of the month, we were already owed some money by our credit customers. They must have made some purchases perhaps back in December of the previous year. This is what we sometimes call the balance brought down, sometimes called the opening balance. That's basically the asset that existed at the beginning of the month. We've then got some transactions during January, and let's think carefully about whether these transactions are going to increase what we're owed by those customers or decrease what we're owed. Well, the first transaction we're told is that credit customers made payments totaling £8,650. Now, if credit customers make payments to you, that's going to reduce what they owe you. So I'm going to show the reductions to the sales ledger control account in green here. So that can be shown in green. That's a reduction. There were then discounts allowed. Now, if I offer discounts to my customers, that again reduces what they owe me. I'm letting them off with part of the balance. So the discounts allowed can go in green as well. That's another reduction to the sales ledger control account. We've then got credit sales made. Now, credit sales increase what these customers owe us. So we've made further sales to them. I'll show increases in blue here. So the credit sales will increase the receivables balance. We've then got cash sales. Cash sales were £2,340. Now, cash sales, they do not affect in any way what your credit customers owe you. These are cash sales. These are customers who've paid at the time of the purchase. That means they don't owe us the money. So, in fact, that's actually a bit of a red herring. That's not something we need to deal with here. The trade receivables account or the sales ledger control account is only looking at credit customers, the amount owed to us by our credit customers. And we then got some information about returns made by credit customers. Now, credit customers make returns to us, and we will therefore be issuing some credit notes. Well, that will reduce the amount that they owe us. If they send some goods back, we're certainly not going to pay for them, so I'll put them in green, along with the payments by the customers and the discounts allowed. They all reduce the sales ledger control account, whereas the credit sales I've made will increase the sales ledger control account. And what we asked for here, well, basically we're asked, what will the balance on the trade receivables be, or the sales ledger control account be at the end of the month? So how much do my credit customers still owe me at the end of the month? Now, to show this, I'm going to set up a ledger account or a T account. So remember, we're dealing with the sales ledger control account here. So remember, we would post debits on the left-hand side, credits on the right-hand side. And remember, sales ledger control account is an asset. This is what we are owed by our customers, and assets fall under the dead in my dead click mnemonic. So therefore, to increase the asset, we need to post a debit. To decrease the asset, we're therefore going to post a credit. Well, let's start building the figures in. So the first figure was the opening balance, or the balance brought down at the beginning of the month. And because that's showing the opening asset, that needs to go on the debit side. That had already been made in terms of sales to these credit customers. So at the 1st of January, I could call this balance brought down perhaps, or the opening balance of 15,430. So I can enter that debit that would already exist, showing the asset we're owed. We've then got the payment made by those credit customers. So in fact, some of those credit customers have now paid off what they owed us. And remember, if we're reducing the sales ledger control account, that's going to be a credit entry. So the payments will go on the credit side, reducing the amount we're owed by these customers. That would be the credit. Obviously, I'd have to post a full double entry. The debit would actually go to the cash account because we've now received some cash, so we would debit cash to increase that asset. But I'm only interested in the entry on the control account here. We've then got the discounts allowed, which we decided was also a reduction to the amount that we're owed. So that'll be another credit entry on the control account, another decrease to the amount we're owed by these customers. The other side of that double entry would actually be a debit to a discounts allowed ledger account. That would actually be showing an expense for the cost of the discount that we've given to our customers. If you give discounts, that's going to reduce the profit you're making. So the debit of that double entry would go to an expense for discounts allowed. But again, we're only interested in the credit in the control account. We've then got the credit sales made. Now remember, this is increasing the amount we're owed by these customers. So I'm now going to post a debit entry to show the increase in the control account of £9,275. So I've got the debit entry on the control account. The other side of that double entry would be a credit to sales to show the income that we've now generated. And we then had the returns made, or the credit notes that I would have issued to those customers. And returns again is reducing the control account, reducing the trade receivables balance. So I can post that as another credit balance, 570. The debit side of that double entry would actually go to a sales returns T account. And I've posted all of the transactions we were told about, so I just need to identify the balance at the end of the month. And we can do that by just balancing off the T account. Now if we do that in the usual way, so if I look at both sides of the T account, now at the moment if I look at the debit side, well, adding up the 15,430 and the 9,275, at the moment I've got 24,705 on the debit side. I'll just take a quick note of that. If I then look at the credit side, we'll add up those three figures, I get a total of 9,650. So you can clearly see that at the moment, the debit side has got the greatest total. So if I put that on both sides, 24,705. So I always think of a T account like a set of scales, and the two sides have to have the same total for the scales to balance. Now, the debit side does equal 24,705, so that's fine. The credit side didn't equal 24,705, so I now need to identify what's called the balancing figure. So what do I need to insert on the credit side to make it equal to 24,705? And in fact, if I take 24,705, I know the total it should be, deduct the 9,650 that I already know is on there. What's my balancing figure? Well, I would need to add £15,055 to make the scales balance. And that balancing figure will be, for the end of the month, the balance now carried down to the following month, to the beginning of February. And basically telling me what the remaining trade receivables balance would be. So just balancing off the ledger account in the usual way. And do bear in mind that because the balancing figure is on the credit side, that was actually because the debit side was bigger in the first place, wasn't it? So when we actually transfer that balance to the following month, it would actually get carried down to the other side of the ledger account. So if I was thinking about February, the beginning of February, the balance brought down at the beginning of that next month would be shown on the debit side. Bit like we had the balance brought down at the beginning of January, because remember, the trade receivables balance is ultimately an asset, so it should be shown as a debit balance. So for instance, on the trial balance, it would be a debit balance, wouldn't it? But in answer to the question, what will the balance on trade receivables be at the end of the month? Well, it's my £15,055 at the end of January, having now posted the various transactions in terms of their impact on the control account. Well, I hope you found that useful. Just a matter of practicing plenty of tasks there, and hopefully I'll see you next time.